Hello, everybody. Welcome to my walkthrough solution of problem 5.5, Wiley Intermediate Accounting. This is the 17th edition. Great textbook. I learned on the 6th edition. Wiley has kindly been allowed me to use their questions. And so just some disclaimers. The question is used in the presentation as copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2021 by Bennett Tchaikovsky. All rights are reserved. The opinions within this presentation are those of Bennett Tchaikovsky and not the authors or textbook or Wiley or any of my employers. Okay, so right over here, let me just go ahead and pause real quick. So this is kind of basically a sequence of videos that I've done for one of my students who's awesome and actually having me do these. I'm glad she asked because it's actually opening up a whole nother level of what I'm going to ask my students next semester at Fullerton, if I do teach there. Okay, so we've got over here, we've got Sargent Corporation balance sheet. And so again, the one where I really kind of get into talking about the balance sheet and showing you different companies is exercise 5.5. That one is probably overkill, but let's just go here to problem 5.5. So we've got Sargent Corporation, balance sheet as of 12/31/20. Okay, so we have to show the breakout of this, and I think it's asking us, prepare a balance sheet in good form, adjusting each classification by the information given above. Okay, so for assets, we're going to use a classified balance sheet. So we're going to have current assets, right? So my first category is going to be current assets, those assets which I'll be using in the year. So the current assets section includes cash of $150,000. It includes accounts receivable less an allowance for doubtful accounts. So 170,000 minus 10,000 is going to give me accounts receivable net of the allowance of 160,000. By the way, I have a lot of other videos throughout my channel where if you're looking to explore some of these other topics that we're kind of putting up here in depth, you can definitely find them or send me a message and I'll point you to the right direction. Okay, my inventories are at 180,000. Now, first problem here, unearned rent revenue of $5,000. What type of account is unearned rent revenue? That is going to be a liability. Okay, so when I look at this over here, right? So I've got total current assets, non-current assets, total non-current assets, total assets, liabilities, current liabilities, total current, non-current liabilities, total non-current, total liabilities, owner's equity, total owner's equity, total liabilities, and owner's equity. Okay, so this unearned rent revenue, this is going to be a liability, okay? So if it's unearned, I have not gone through and performed yet, meaning that the tenant hasn't lived in it yet, so unearned rent revenue is going to be a current liability. Inventory is stated at the lower of cost or market, a lower cost of FIFO cost or net realizable value, which is the way that it should be, so I don't have to go through and adjust this item. Okay, so we've gone through and all we've really done here is we've moved unearned rent revenue that should not be a current asset. Rather, what our current asset should be is basically this 150 plus 160. What is the 160 coming from? It's receivables less the allowance for doubtful accounts plus the inventories. So I'm not going to total these up yet just because we may have more things that are coming in here. Okay, so the investments. The investment section include the cash surrender value of a life insurance contract. Do I want to separate that out? Oh, absolutely, yes. Okay, so we've got over here cash surrender value of life insurance is going to be 40,000. Okay, investments in common stock short term, 80,000. Okay, this is why I didn't want to total it up. Now, if I have short-term investments in common stock, that means they are current assets, meaning that I'm planning on to either liquidate or term out. So basically, what I'm going to go through and do is I'm going to put these up here as current, or basically marketable securities. Short-term or investments in common stock. Short term. Why am I putting this ahead of accounts receivable? Okay, so the reason why, and I kind of talked about this on the exercise 5-5 video, but it's worth repeating again. I have to put the ordering of my balance sheet accounts is typically going to be in order of liquidity, right? Cash is by far the most liquid. Investment in short-term, securities, this is going to be more liquid than AR because I could pretty much sell it immediately if I had to. AR is a little bit different. AR is I have to collect it. Inventory is less liquid than accounts receivable because with inventory, I have to first sell it, right? So as we go through and look at this here, that's how that works. And if you just want to take a look, and I did this previously for the other question, but right over here, if I look at Apple, and I go to Apple's, any of their financial statements, and I really like the way that Apple lists out their balance sheet from an educational standpoint, because I think it does it the best. So right over here, when you see that how Apple lists it out, they've got cash, marketable securities, receivables, inventory. So this is how Apple's going through and doing it. So it must be correct. I'm just kidding. It's on the internet. It must be true. So that's where we're going to put that short term. Okay, so life insurance contract, investment in common stock short term, we're moving that up. And then over here, we're going to basically have long-term investments. And this is going to be 270,000. Now, the bond sinking fund, I looked at that in exercise 5-6. Basically, it's money that we're setting aside to put aside over here. So my bond sinking fund is going to be at $250,000. Okay. Now, what you're noticing here is that I'm basically dumping out and listing out everything for the assets under non-current. You'll see in the solutions to some textbooks that they put them into different categories, right? I just don't do that. So it's really, up to, and I'm following with what most publicly traded companies do. Okay, so right over here, so that's my investment section. Then the next one over here is property, plant, and equipment includes buildings of $1,040,000. So right over here, buildings less my accumulated depreciation is going to give me buildings net of depreciation. Okay, so my buildings is going to be showing over here at 680,000. Okay, so basically I have over here, so property, plant, and equipment includes buildings less accumulated depreciation is going to basically be giving me here buildings net of 680. Okay, so equipment 450,000. So my equipment had a balance here of 450,000. My accumulated depreciation was 180. So my equipment net is going to be at 270,000. Okay, so let's go to the next one over here. The next one over here is land is at 500,000 and land held for future use was 270. Land held for future use. So what's the difference between those two? Well, land is obviously we've got the building is sitting on the land, And then the land held for future use. What is that exactly going to be? Well, that's this land that we're going to be using at some point in time in the future for our operations. We're separating it because it's not that this land is used for speculation, but we're just going to be using it in the future. Okay, we got some more non-current assets. We're going to give ourselves a little bit more breathing room. Okay, so our next one over here is we have intangible assets. Okay, so franchise is 165. Okay, and then over here we have goodwill of 100,000. Okay, discount on bonds payable, right? Discount on bonds payable is a contra liability account. So what we're going to do is that under non-current liabilities, that is going to be showing up down here, right? So this discount on bonds payable, this is what reduces. We use a discount if we sold a bond below face value. So right over here, basically the bond payable. So it says here, long-term liabilities are comprised solely of 7% bonds payable due 2028. This is a long-term liability because it's a year beyond the balance sheet date. So what I'm going to do here is I'm going to show bond payable at $1 million less my discount on bond payable, which is going to be 40 grand. This is going to give me bonds payable net of the discount. Okay, so this is how I go through and show it here, right? So if you noticed, if it was a premium, I show bonds payable carrying value. Okay, so I just do it a little bit different here. Okay, so, all right. Okay, so jumped ahead a little bit because this discount should not be listed in intangible assets. Okay, so current liabilities include accounts payable. So let's go ahead and start listing these out. Okay, so for our current liabilities so far, we have unearned rent revenue. Okay, the next one is going to be accounts payable, 140,000. Notes payable short term, 80,000. Long term. Okay, so long term, it's got to go down here. Or what I would call a non-current liability. Okay, so this is going to be over here. It's going to be 120,000. Income taxes payable is going to be 40 grand. Okay, so right over here. Okay, and if we make this into dollars, all right. So I've dealt with, so we've got here, current liabilities include accounts payable for 140, notes payable short-term 80, long-term notes payable 120, not a current liability. Remember, current liabilities paid within the year. And then income taxes payable 40 grand. Long-term liabilities, we just dealt with that. So this 1 million is a bond payable. Right, so over here, so that bond payable is going to be a non-current liability. I'm subtracting the discount on bond payable, and that was coming from number 4. That's not an asset. Okay, so over here, so my total current. Let's wait. Let's before we total things up, let's finish this problem. Okay. So stockholders' equities has preferred stock, no par value, authorized 200,000 shares, issued 70,000 shares for 450. Common stock dollar par value, authorized 400, issued 100,000 shares at an average price of 10. In addition, the corporation has retained earnings of 320. Okay, so I don't know what that means. When I see average price of 10, like you would never. I'm assuming that that's going to be an average selling price of 10. So let's have some fun with this. All right. So under the owner's equity part here, I'm just going to move this down to kind of help us out. Okay, hopefully I don't screw this one up. All right, so let's kind of go through here though so far, and let's like add up to see where we are, right? So my total current assets are going to be 150 plus 80 plus 160 plus 180 or 570. I'm just going to flush this over a little bit so it's not as cramped. My total non-current assets are going to be right over here of 2,545,000. So my total assets are going to be 3,115,000. My current liabilities are going to be 5 plus 140 plus 80 plus 40 or 265. My non-current liabilities are going to be, let's move this around. I had a long-term note payable. My bond payable net was 960. So my total non-current liabilities are going to be 1,080,000. And now we're ready to take a look at owner's equity, and my total liabilities are right over here. This is going to be 265 plus 1,080,000 or 1,345,000. Okay. So now let's take a look at owner's equity. Okay, so we have over here preferred stock, no par value, 200,000 shares authorized, 70,000 shares issued and outstanding. Okay, and so this over here, because it's no par value, this here is just going to be the amount that it is, which is going to be 450,000. Okay, so that doesn't really, that's not going to go through here and change. Okay. Now for the common stock, right? So common stock, dollar par value. Watch one of my other videos to tell you why that's never a good idea unless you're Berkshire Hathaway. Authorized 400,000 shares issued, and 100,000 shares outstanding. Okay, at an average price of 10. Okay, so when we show our financial statements and owner's equity, we're breaking these up into two different parts. It's going to be common stock at par and additional paid-in capital common stock. And when you look at this over here for, and this isn't a good example, let me show you a different company. Let's look at our friends at Facebook. And if we take a look at the financial statements of Facebook, and if we look at their balance sheet in particular with regards to their equity presentation. So when I look at owner's equity, you'll see here it's common stock at par. Basically, what's the par value? And then we have additional paid-in capital. Now, because Facebook has their par value of their shares is so low that their par value, these are in millions of dollars. And so their par value is not showing up at all because it's below $1 million or it's below 500 grand, right? So it's probably, it's a very small amount. So over here though, when we assign par value, right, the authorized just tells us how many we can actually go through and issue. What we're concerned with is what is our issued and what is our outstanding. Okay, so here, the dollar par value, so this is going to be $1 times 100,000. So my amount that is going to par is going to be $100,000. Okay. Now, if I'm going through and reading this correctly, right, what I would typically then do is go through and say, is that okay? If the average price is 10, right, what does that mean? Well, it basically means they sold stock at 10 bucks a share. So if I have 100,000 shares outstanding, and my average share price was 10, the amount of money that I got in total by selling these shares is going to be $1 million. When I sell stock, the way that I do the journal entry is I'm going to debit cash, right? I would debit cash here for the million. Then what I do is I split it up. I first put it to common stock at par, which was basically 100,000 shares times $1, because that is the amount of the par value. And then the rest of it is going to be dumped into additional paid-in capital common stock. So additional paid-in capital common stock is going to be $900,000. Okay, so I've got common stock at par, additional paid-in capital common stock, right? That's how I have to go through and split it up. If you notice the disclosures I'm kind of going through and following, it's very similar to here. You say the par value, the number of shares authorized, and then you have issued and outstanding. Why would there be a difference between issued and outstanding? It really has a lot to do with shares being repurchased by the corporation. So the best example to look at shares issued and outstanding is the Home Depot. If you go to Home Depot, right, and we look at the financials for the Home Depot, and this is the one I love to do when I'm talking about treasury stock. If I go over here to the Home Depot and I look at this over here, what I'm going to notice is that you have over here issued 1.7 billion shares. And basically over here, it's 1,000,056 shares outstanding. What's the difference? They've repurchased $735 million of their own, 735 million shares of their own stock that they spent $72 billion on. So they're literally swallowing themselves over time. That's what they're doing. So they're just basically buying back all their own shares. So right over here, when we look at owner's equity, right? So we've got preferred stock, you could say no par value, authorized 200,000 shares, and this is going to be shown at 450. But if we have a par value, then we have to go through and then show it like this. And then lastly, we're going to have retained earnings of 320,000. And we'll see if I'm close or if I'm not close at all. So let's go ahead and take a look at this. So we've got owner's equity of 1,770,000. Okay, and I think that that actually ties in with this 1,770,000 that we had up here. But now let's look at the big question. Do our liabilities and owner's equity, what do those total up to? I get 3,115,000. Okay, I think I'm supposed to say like 4 Hail Marys. There we go, and it balanced. Wow, it's exciting. Woo! Oh, thank God. Didn't even look at those. I did. Now look at these solutions. I don't think I did. Maybe I did. I don't think I did. Let me see if it's right there or not. Just give me a moment. So my solution is pretty much the same as the textbook solution. The one thing that they're doing, though, a little bit differently is that they're grouping, they would call these intangibles. Over here, they would be calling this one, you basically would say like other, like maybe like investments. And then they're going to say that this is property, plant, and equipment. But as you can kind of see, though, from most corporations, like what they'll do is they show current and then they list out everything else. So they're just going to basically put it out as, and like list it out as other assets. So that's this particular question. Again, wow, this is a really good question. And I want to thank my student who shall remain nameless because I don't want to make her YouTube famous, but she really deserves it. She had actually asked me to do these 3 questions here, and this is the last of these 3 questions. And she said, "Hey, Bennett, like, you're an idiot." She didn't say that. She said, "Bennett, you've given us questions that I absolutely don't understand. So will you go through and do the videos?" And now I understand why she asked me to do them. So again, hopefully you found this video helpful, and I will see you on the next video. And let me give my thanks and my shout outs, and let's go here. So again, thank you, Wiley, for allowing me to make these videos and making them legit. I don't have to call myself Accounting After Dark anymore, although that's a lot more fun. Please don't forget to like and subscribe. If you need other solutions like walkthroughs like this that violate every YouTube rule by being way too long, feel free to ask me about it. So have a great rest of your day, and I look forward to seeing you on the next video. Have a good one. Take care.